founder or an entrepreneur. You wanna take your company value to 300 million, we gon' show you how to do it. Well, we got the roadmap, your aspirations. We'll give you a game plan and strategies. Seize control of your company's destiny today by tuning in to Private Capital Mastery. Yeah. Let's start the show.
Welcome back to this episode of the Private Capital Mastery podcast and community. I'm your host, Brian Franco, and today we will be diving into the details of how to enhance your enterprise value through professionalizing your financial function. And I wouldn't have anybody else here with me other than Francois Muller to talk about this very subject. He is a forward-thinking professional for the last 20 years dealing with corporate finances, private equity transactions, whether that be debt and or equity. Francois, thank you for joining us. Thank you for being here.
Brian, great to be here. Super excited to have a good conversation on this topic and beautiful setting.
Yeah. I mean, I'm sorry it's not a little sunnier today, but I think actually you're headed over to the Newport Beach boat show after this, right?
I certainly am, and no, it's beautiful. Thank you for having me.
Yeah, thank you for being here. So let's talk about this because we at Meritage Partners, we spend our time with founders and entrepreneurs, and we work very hard up front to make sure that we are collapsing time for our clients, because you and I both know in the M&A world, number one rule is time kills deals. And there's no way that you and I can collapse time within the process. It all happens prior to, don't you agree?
That's well put. I think there's multiple ways of going to market. Sometimes it's fire sale and you got to get done what you can do. But in order to really be strategic and thoughtful about it, planning should start well beyond or a lot earlier. Sometimes even prior to engaging investment banking.
Yeah, I agree. In fact, that's why we've developed this podcast, is because we wanted to inform and educate and provoke thought in those that are tuning in, because if they can pick up nuggets of knowledge and information that would drive them into a trajectory that they otherwise wouldn't go on, we will meet them again at that moment in time. But this is a great opportunity for them to get inside knowledge, understand even not only our playbook but your playbook, and how you work with your clients. But let's dive into that, because what would you say the biggest challenge and or problem that a founder or an entrepreneur would face when let's reverse this, right? So how are they not enhancing their enterprise value, or how are they deteriorating their enterprise value by not professionalizing their financial function?
Yeah, I think that's sort of the core here. I think what we see oftentimes happen, and I've done a multitude of transactions.
Yes.
And what's really driven me to start doing this is the fact that I see so many owner-operators, great operators, leave a lot of value on the table during a transaction for not having done some of the prep work and now scrambling here at the 11th hour to be able to produce the data.
Yeah.
So oftentimes what I think is the problem is great operators, great businesses, but they sometimes struggle to figure out really how do I present my business through the lens of financials, data points, KPIs, et cetera, so that when you have an interested buyer, you can really make a stronger case for a higher transaction value.
Yeah, exactly. And logically, I think of most everything in business as an ROI, a return on investment, right? And so let's frame what it means to be what it takes to undervalue your company, because let's quantify that. So we talked about how leaving value on the table, but what does that mean? So let's say I'm in an industry that's trading at 5 to 7 times my adjusted earnings, okay? And if we take that equation, 5 to 7, very simple math. So 1 times 5 is $5. So every dollar you find, it's worth $5 from an enterprise value standpoint. If we're trading at 7 times or 10 times, so on and so forth, right? So in finding those dollars, it's not like you're reaching into the entrepreneur's pocket and trying to look for loose change, right? We're diving into the financial statement and understanding, what their bookkeeping has looked like historically, how could it be improved, what KPIs could be added to the organization. Can we talk a bit about that?
Yeah, absolutely. And I think I'll take it a step back. Entrepreneurs typically underinvest in their finance and accounting function, right? It's one of those things that you have to keep track of because you have to do your taxes annually and so forth. But beyond that, they have a lot of knowledge about the business in their heads, and they don't track all the data points, and they've got a good sense of, if something's a little bit sideways or not doing too well. But being able to translate that and communicate that post-transaction or during a transaction, pre-transaction is challenging,
Yes.
So what I think of as sort of leaving value on the table, and instead of trading at that 5 times EBITDA multiple or adjusted earnings multiple,
Correct.
If you can start presenting financial information, not just accrual accounting, because there's a lot of nuances between accrual and cash accounting, and that impacts the basically the adjusted earnings that a buyer is going to look at and value the business on.
Yeah.
And sometimes, just those adjustments alone can have an impact to the number that's being put out there that grounds the value, enterprise value.
Correct.
And that's just accounting, right?
Okay.
That's not cash flow. That's nothing else. That's just what's EBITDA versus,
Yes.
when you do the books versus when we get a buy-side diligence team in there, and it looks a little different, and that has an impact, right? So that's one thing that we leave value on the table, or at least, it creates friction in the transaction. The other piece is we really add value is, hey, now we've got the historical data where everyone's on the same page from the get-go on the GAAP accounting, but we've also started budgeting and planning and tracking KPIs. So I can start showing a history of certain metrics that we may have or may not have managed and how they've improved or not. So when a buyer comes in and they get to look at some historical data points, it's more transparency. It's a lot easier for them to forecast, project what the company may do post-transaction, and that's a value enhancer. And when that happens, you're not going to be at the 5 times adjusted earnings, but maybe you're trading towards the higher end, 7 times adjusted earnings.
That's right. That's a great way to put it, because the history of the organization and that's really recorded by whatever accounting functions they have in place at that moment in time or historically. But as you know, what gets measured gets multiplied in these transactions, and we all have heard the phrase as well, and I say this time and time again that what we can't measure, we can't improve, right? So by implementing those KPIs, you're giving leadership and management the ability to have optics on their business. So in some cases, you could do this from a day to day, week to week. I mean, some companies do have real-time recording, which is great, and we're getting closer and closer to that even in smaller organizations. But what does that process look like when you come in and you consult and advise a company that is preparing to either enhance their enterprise value for an exit or enhance their enterprise value to access debt for additional growth and scale through, whether that be organic growth or growth through acquisition? What does that process look like with you?
Yeah, so typically we kind of get involved and help companies. We start with a baseline, right? The table stakes stuff. Let's get accrual accounting, understand exactly where we are, take stock.
Yeah.
Right. Once we get the accrual accounting process in place, then you can really start managing. And what we do is we provide more strategic services. So, as you do the accrual accounting, that's basics, that's relatively inexpensive, but it really comes down to, all right, so what do we need? Are we tracking our budget? Do we have an annual operating plan? Are we forecasting? Do we come back and look and see, what, this month we didn't quite perform the way we wanted to based on what we expected to do, and why? Right. I think oftentimes if you're managing on a cash basis, you get financial reports 2 months after the fact because it takes the accountants or the bookkeepers a while to get it to you.
Correct.
Then you're starting to tweak things, and you don't really have good visibility into what are my gross margins. Are they getting compressed because input costs went up?
Yes.
Maybe it did, but we don't get the data to see that. So it comes down to having projections, then measuring, after the fact to see how do we perform and what's driving change, whether it's in your adjusted earnings, whether it's in gross margin, and in between. So, and then beyond just the pure sort of financial KPIs, you can get into more operational KPIs, right? If you're a software business, for example, most software companies do this and they track it, but if you have a recurring revenue stream with your customers, you know, knowing what your historical churn is or your historical retention rates are, that typically helps, and that again, that's a value driver. You can say, look, we may have lost some customers in this period, and these were the changes that we implemented in the business. Perhaps that was a good or not a good decision, right? So there's softer things that you can glean from data, but you need the data to be able to start managing.
Is it, and said differently, is it as simple as saying that those that are focused on cash flow are going to subscribe more to cash basis financial statements?
It's not so much. I think cash is king, right? An entrepreneur is always going to look at cash flow. It's important from a pure, being able to make payroll, being able to think through capital investment, through debt service, bringing on, debt capital, or even through a transaction. So that matters. I think understanding the differences between cash and accrual is important. Again, when you value a company, it's usually on an accrual basis. What's EBITDA under GAAP accrual accounting? So there is a little bit of a difference. In some industries, it's a lot bigger. In other industries, that variance is not so big, and it's not such a big deal. But I think it's more a function of you need more sophistication and horsepower in your finance function to produce accrual accounting. And it's oftentimes not really a priority or a focus for an entrepreneur or an owner of an organization, because to them, there's accounting mumbo jumbo and it doesn't necessarily add value, right? Like, what is the cash implication? But, to give you an example, working with a client that, great business, growing, and they bill customers in advance, and then they have a few months service. And for them so they get, they've got this lumpiness in their cash flow.
I see.
And so they want to be able to kind of see, what are we doing on a run rate basis, right? What is our annual recurring revenue? And start thinking through those things. And then beyond that, it's not just, all right, well, we get our books done, but hey, we need to add more resources to the team. We have to do some hiring, headcounts. If I bring somebody on in 3 months from now, what's my cash position going to be in months 4 and 5? Is it going to be a real strain? So it's really starting to look forward as you grow the business and start thinking through, all right, if I need to buy a new piece of capital equipment, I'm probably going to have to bring X out. And then it turns into a little bit more of a strategic discussion, and you can model the cash flow. That's important too, right? So
but the modeling of the cash flow derives from focusing on that cash to accrual conversion and measuring the business on an accrual method, because to your point, then you have a set trajectory. You know where you intend to be, and then you have those weekly or monthly, likely monthly measurements that tell you, okay, do we need a course correct? Are we on the right course? And it certainly helps you navigate. But I think that, and said differently, and in layman's terms, right? Why would a founder or an entrepreneur who has for the last 20 years been operating on a cash basis accounting, right, help them to subscribe to this method of conversion to accrual for purposes of measurement? Because, spoiler alert, it all equates to increasing your enterprise value, right? But walk us through that and why that is, and how would an entrepreneur identify and subscribe to this whole concept? Because I'll tell you, I've been in many settings, and it's not always understood why this conversion occurs, cash to accrual. But we do have a level of extreme level of trust with our clients, so they're following our lead from that standpoint. But drive it home. How do you help an entrepreneur understand the importance of this sort of professionalization to their financial bookkeeping and function?
Yeah, it's I think there's a couple of things, right? Aside from the fact that if you have accrual financials, it gives you a lot more credibility as you go through a transaction. It's going to get diligence. People are going to kick the tires. But as an operator, if I'm managing my business, producing data beyond that is important, right? So instead of shooting from the hip, now you're managing the business on data. And I think data is an important part that's oftentimes overlooked. Or a business owner or operator has, it's in their head, they get it, they understand it, and or they think they do, and sometimes the data could tell you something different, and it allows you to pull other levers. So I think it's not just let's do accounting right, it's really, all right, this is how it influences accounting, but ultimately where we add value is, the basic value of, look, we've got quality financials, it's timely, we can make decisions that actually impact the business based off of it. But then it's sort of getting data beyond just accounting data to really manage the business. And that drives value too, because in a transaction setting, pre-sale, you can start framing how do we get from A to B, and here's some data points to support the financial data. So it's a little bit of both, right?
Yeah, it is a little bit of both. And so if I were to distill that down, what you just described, looking at your business, operating on an accrual method accounting is going to give you the accuracy that you need to make the decisions that need to be made, but it also increases your enterprise value because it's providing detail, both historic and forward-looking, for outside parties like debt investors, equity investors that are now looking at your business in different ways than an operator is going to measure their own business, but they could take information that otherwise wouldn't be available if it was simply on a cash basis accounting method.
Yeah, I think that's accurate. Sorry.
Yeah.
I think that's a good point. As I'm thinking through it too, just trying to get a little further along, if you get through a transaction or get to the point of entering into a transaction, typically in a lot of these purchase sale agreements, there's a thing called net working capital and adjustments, and trying to recreate that or trying to figure out what those accrual accounting numbers are, which ultimately impact your valuation, because there's a purchase price adjustment based off of actual versus what you're projecting it's going to be at close.
Correct.
And if you have a little bit more history, you've been tracking it all along.
Yes.
You can really be a little bit more sophisticated and better at negotiating that part of it. So it comes into play through a transaction in a number of facets.
Yes.
It's not necessarily going to make you operate the business better, but it has, it allows you to do more things and be better prepared.
It does, absolutely, because those tuned in and listening to what we're talking about, what can happen if you don't have those measurements in this method, it's difficult to calculate net working capital. So at the point of negotiation and M&A transaction, let's say it's a sale, what will happen is we're going to put a pin or a placeholder for what we think and what we believe the net working capital is at that moment in time, and how it's going to play out between now and to the date of closing. But if you could have that accuracy today, you're going to avoid a lot of pain in those negotiations, because what you think you're pinning today, if it's unknown, and then where you end up at the closing table, more often than not, we're sitting there arm wrestling over what the net working capital number should be or should not be. And from as a professional negotiator of these transactions, I would much rather know what that number is up front, so that I can then navigate the other elements of the transaction for our client, and with certainty, with accuracy, and with confidence.
Yeah, that's very well said. And just to add to that, I've seen it, and I'm sure you've seen it countless times too, where a seller goes through a process, they have a very sophisticated private equity or institutional buyer in there. Yes. And these guys end up recapturing some value. Maybe it's month, 2-3 months post-transaction. There's a true-up adjustment because you weren't prepared on the working capital side, and it's not a fault of your advisor or somebody helping you through the process. It's a function of just not knowing the numbers. It's really hard to recreate in hindsight, in retrospect.
Yeah, and so we talked about the challenge and the problem associated with not having a professionalized financial function in a business. We talked about those pain points that are felt, by entrepreneurs day after day after day, especially in an environment and in a setting where we're negotiating an M&A transaction or some sort of capital event, right? Fill in the blank. And then we also talked about how do you cure, these challenges. And you said it earlier in this podcast, and that is, focus on professionalizing your financial function by way of looking at your business, by converting it from cash to accrual. There's much more than that. You and I both know, and every business requires different KPIs and measurements. You gave a case study just a moment ago about a company that generates annual reoccurring revenue, so they're getting paid up front, which who doesn't love to be paid up front? But you have to be able to then budget that cash flow, right, for the remainder of the year until that renewal comes up in that business. And we see that more often in software companies than not, right? But then you have to consider, okay, what is our renewal rate, right? Because if the renewal rate is low, then it's very foreshadowing and telling that, okay, it's unlikely you're going to replicate these revenues year after year after year because you have a 70% drop-off rate, right? So these KPIs are important. These measurements are important. What else would you leave those tuned in and listening in, with in terms of knowledge?
I think in that example too, you wouldn't believe it. As a finance guy, money today is worth more money tomorrow or down the road.
Yes.
Some operators are like, well, it's really hard for me to track or manage my cash because if a guy pays me today, I've got all this cash. They actually say, you know what, the customer wants to pay me a $30,000 check and do it all up front.
Yes.
But I'd rather bill them monthly just so that I don't have to deal with a headache of trying to track where we are in the process, right? And if you're just keeping good record, you can avoid that, and then you have cash in the bank, and how much of that is really at your disposal today, if you will, right?
But that case study illustrates the fact that curing the problem in that way is a Band-Aid, because what that owner did not understand is what you already said, and that's cash today is worth more than cash tomorrow, right? And so, he or she thought they were fixing and curing that problem with that solution, but they're wrong simply, and you were there to help them, course correct and right size it. We also see this in a franchisor setting. We have a case right now where franchisor collects certain fees up front from the franchisee, but those fees cannot be recognized as revenue until the franchisee's location opens. And so they're on their balance sheet, they're sitting, flush with cash, but this is cash they can't recognize as revenue, per regulation, right? But those are things that have to be considered too, because, what if that franchisee never opens that location? Yeah. Where does that money sitting on the balance sheet go? Typically, it goes back to the franchisee.
Return it. It's
right?
a liability until you've earned it.
Yeah.
And to take it one step further in the context of a transaction, when you're looking at adjusted earnings, it's not yet been earned, so it can really have a big impact to that number, and that number is very critical from a valuation perspective. So,
Well, Francois, you are a wealth of knowledge. I hope that everyone tuned in is really appreciating and enjoying the information you've shared. Those that want to get connected with you and interact with you to see and discover how your firm may be able to help them, what's the best way to reach you? On LinkedIn, I imagine.
Yeah,
right?
I think the easiest way is just connect with LinkedIn. Always open to have a discussion, see if we can be a resource at Maven, and I know we got pretty technical and into the weeds of the accounting stuff today. It's not the most exciting topic, but it's an important one, and it's helpful, right? It's helpful if you're thinking through a transaction and exit, and
Yeah.
You don't have to say, you know what, I'm not going to do accrual accounting because it's going to, it's an arm and a leg. It's really
Correct.
expensive, right? You can.
Yeah.
There are providers out there that can support through that process, but really, just Brian, I wanted to add, and we never really touched on it. Like we're talking about data, KPIs, accounting,
Yes,
software,
yes.
but the piece that I think is valuable is having somebody that's been there, seen that through a number of transactions, and as you're managing your business, even if you're not yet ready to exit or you don't know if you're sure about it, having an advisor by your side to just say,
Yes.
do we need to raise debt capital to do this, or am I saving my cash and then I don't have any, So it's thinking through your financing structure, your
That's right.
finance structure. Do we need to refinance things out? And really, beyond just accrual accounting, all right, now we have the data, the baseline, the stuff where we start. How do we manage the business and optimize to be efficient from a financial and capital perspective? Manage our working capital, or manage our true, capital structure, so we're not paying too much to debt or other capital providers, right?
Yeah, no, you're exactly right. I'm glad you touched on that because we did get pretty granular and into the details. I mean, I love nerding out on these sort of topics, but when you put this back to layman's terms and you describe what you just did, it's very helpful for an entrepreneur to understand. There's a lot to unpack here, and it's hard to do in a setting like this, but at least gives some bite-sized nuggets of information that they could further explore. Because as from where we sit as an M&A advisor and as an investment banker, what we want is as many tools on our belt that we could possibly have as we step into that negotiating arena and negotiate shoulder to shoulder with our clients. And if we're able to, because I say this, but if we're able to see around corners and see through walls and know what's to come, it is much better and much more efficient, and certainly collapses that time we were talking about by having those tools at your disposal in those types of settings. And so for that reason, I encourage everyone, wherever they are, whichever industry they are, to reach out to Francois, learn more, and implement these systems. And what we're calling is just professionalize your financial function. That's it. That's the key takeaway here.
Yeah, think of it as you could turn it into something that creates value versus this cost center of doing the books, right?
Yeah.
And
Yes.
and that's really what you need to think about if you had to dumb it down.
Yeah.
Use it it's going to be there. You're going to use it for taxes, whatever. You may as well maximize the value you're going to get out of it.
Precisely. And that really comes to the conclusion of this episode. How do we enhance value through this professional financial function? Francois, thank you for being on this episode. Love to have you on in the future, and I'm sure I'll probably see you over there in about 20 or 30 minutes. But have a great time at the Newport Beach Boat Show, and I'll see you soon.
Thanks, Brian. Always happy to be. I'd love to come back, and thank you very much for hosting.
Yeah, of course. And thank you for tuning in and learning how to enhance your enterprise value by professionalizing your financial function. We hope that you tune in next week as we continue to unpack more of our playbook and more details on how you prepare for the private capital markets. I'm your host, Brian Franco. I'll see you then.